This is Eric Mwadu with Mwadu.com. In this video, I'm going to discuss the UltraShort and how they perform in relation to their exact mirror image instruments to see how they stack up in terms of performance. Now, what you're going to find is really a little bit troubling. But if we take a look, and what I did is I'm comparing this, the exact opposite instruments from the same fund company. So I'm not using two different fund companies. I'm using the same fund companies to show you how the exact mirror image instruments are not doing what they should do. They are not performing as designed in theory. If you take a look at the UYG, which is a 2x financial bull ETF, this was the return in 2008. It was down 83%. That's a huge drop. So if you thought the financial market was gonna be in trouble, then and you knew that UYG was gonna drop, then the best way to have played this scenario was to go along the SKF. The SKF is 2x financial bear ETF. But what is surprising is that in 2008, as of the close, SKF was up only 5%. Compare that with the 83% drop in the mirror image instrument from the same fund company, ProShares. Again, same fund company, ProShares, the exact opposite, only gave you a 5% return. Now, notice this line that I've drawn here represents the close as of to the end of 2007. So as of the end of 2007, notice how SKF was trading lower pretty much for a big chunk of the year. This trade here was below, you were losing money in 2008, pretty much almost the entire first quarter, and you are also down a huge chunk here in the third quarter of 2008. Now compare that with this line that represents the close in 2007. The UYG was not making you money at any point after the first 3 weeks of the year. So there is no action above this line here, and yet the SKF, you are underwater. Even though you were correct in the direction of the market, you were losing money for most of initially the first half of the year and also towards the end of the year. So you really ended up making net only 5% if you held on, which is troubling to say the least. Now, if you take a look at this new instrument, the FAS, which is 3x financial bull ETF, for 2008, the return was 54% lower, okay? While FAZ, which is a financial bear ETF, was also, and I repeat that, was also down 40%. So both of them were down. Now, as of 2009 to date, this is February 6th close, FAS, the 3x financial bull ETF, is down 57, almost 58%. The mirror image instrument, congratulations, is only up 14.68%. Guys, these instruments are not giving you the returns you think they should. In other words, the theory is correct, but in reality, due to compounding, due to the reality of mathematics, and the fact that some of these financial companies include volatility to their calculations, basically you're losing money when you buy this UltraShort 2x or 3x bear ETFs. To me, they are not the way to play a dropping market. We need to rethink the way we trade. These UltraShort ETFs, in one word, they suck. This is Eric Mwadu with Mwadu.com. Peace and blessings to you.